Alright guys, so I've been waiting to make this video for a while, but basically I'm going to break down everything I do from step 1 to literally taking a trade, closing out in profit, and everything I do to basically find trades that fit and align with my strategy, because it's really not that complicated, and I think a lot of people are trying to make it harder than it actually is. So I just want to break this down for you guys. It's extremely profitable. I mean, I've been using it. Wins. I already had one small 3K loss like 2 weeks ago on GBP JPY. Other than that, I've won every single trade for the past 5 weeks, averaging 1 to 2 trades per week. So I'm probably on like a 4 trade winning streak right now. Plus the 4 trades before that loss were also wins. So all in all, probably like 7-1 or 8-1 in the past 5 or 6 weeks. And that's not even counting what happened before then. So if I want to break down this strategy from step 1, basically what you want to do is you want to do a top down analysis. This is a trade that happened today. I just closed out in take profit recently, and I can use it as an example to basically show you how do I do my top down analysis. That's how I start off. I start off on the top, and then I always want to go down the time frame. So usually I'm starting off on the daily. Sometimes I'll start on the weekly, depends on what I'm looking for. But if I'm looking for a big move, I'll look at the weekly and I'll basically just write down, are we bullish or are we bearish? In this case, we'll put here that the weekly, but then we could go down into the daily, right? So what am I looking at to see if it's bullish or bearish? I'm looking at the lows and I'm looking at the highs of the market. If the lows and the highs are consistently lower than one another, then that tells me it's obviously a bearish market, something like this. So you see what I'm drawing here in the black circles? That shows me the lows and the highs. So the lower lows, lower highs means a bearish market structure, and the market's most likely going to continue to go down. So when you see this, you know the market's going down, and you could basically just write that it's a bearish market. So we'll put here that the daily is also bearish, and we can move on to the next time frame. So I start off on the weekly or the daily. Sometimes I don't look at the weekly because it's just too much information. But that's why for the weekly time frame, I'll look at just the past couple of candles instead of like going too far back. On the daily, I always check it. The 4-hour time frame, I also always check it. Now here on the 4-hour, you'll see that we have a higher low, but that's not a bullish trend because we're still forming lower highs. So because it's lower highs and there's previous lower lows in the past, this is still considered a bearish market, even with that higher low on the 4-hour, because that's not that significant of a higher low. So with that being said, you can literally see that now the 4-hour time frame is bearish as well. And once you do your analysis like this, you're going to start to find that the trade setups are a lot easier to find, because when you have time frame alignment and they all show you the same thing, then it's pretty clear where it's going to go. And that's how I found this. I saw that some people were buying on USD CHF and I didn't quite understand it, because for me this was probably the most obvious sell position you could have ever found. So from here you go down into the 1-hour. This is the last time frame analysis that I do. This is the smallest time frame I'll use, and here we'll see that we're basically bearish as well because of this big move down here. This confirmed that the market was bearish, and then we continued. Yes, we made a high, but this high is still lower than this high, therefore we're making lower lows and lower highs in the market. So let me keep this chart as clean as possible. Let's use these circles to mark, where it is, basically right here. So you see how this high is currently lower than this one, confirming that it's bearish. So you have the bearish time frames on every single one of them. So now that you have that, it becomes a lot easier. It's like, okay, well, let me just wait for a pullback into a certain area. In this case, the pullback was actually very small into this area of resistance right here. But nonetheless, I saw that pullback and I saw how it rejected off of that pullback. So I was like super confident that it was going to go down. A part of me did want to wait for a deeper pullback, but I knew when I saw those rejections, it's going to go down. So I couldn't miss out on this trade, and that's why I entered it right here. By the plan, by the book, it's a little risky, but I know from experience that when that happens, it's probably going to keep going. So I just entered in right there. How I find my trades is pretty simple. I do my top-down analysis to get the trend and to get my direction. If most of the time frames are in alignment, at least 3 out of the 4, then I start looking for trades. When I'm looking for trades, how do I actually find them? All I'm simply doing is waiting for a break and retest. A lot of people get stuck because they look for the break and retest only on the 4-hour time frame. I'm not doing that. I tried doing that and I missed a lot of trades. If you look for only break and retest on the 4-hour, you're going to miss a lot of trades. So as you see right here, this doesn't even look like a break and retest on the 4-hour. You have to use the smaller time frames. I'm using the 2-hour nowadays a lot and the 1-hour. I found the trade like this, and then I use a confirmation. I have 2 confirmations that I use, 2 models, I guess you could call. I have one that's a rejection. So if I see a big rejection wick or multiple rejection wicks, then I'll enter in short. Or if I see an engulfing candle to go short, I use the rejection candlestick wicks. So we had 2 wicks right here. That's what made me enter this trade. So that's how I find the actual trades themselves. I do my top-down analysis like this, and I'm watching how is price reacting. I want to see bigger candles to the downside if I'm looking to sell than bullish candles. I would never sell. If you ever see that the bullish candles are on average larger than the bearish candles, don't enter short. For example, right here, if you take a look at this market, we'll see here massive bearish candles, and then you have bullish candles coming right after them. But what do you notice? You notice that the bullish candles are a lot smaller than these bearish candles on average. So if you just take this candle, for example, it's a lot smaller than this one. And where does the market go? It continues down. And then at this point, you have these candles, which are pretty small bearish candles, which is not a good sign to go short. But then here you have big bullish candles. And then what ends up happening after that? The market continues to go bullish. And if you look at the green candles inside of this square, on average, they're larger than the bearish candles inside of this zone. And that leads to the market going bullish. It's really, really that simple. In this case, they were all candles were kind of small because that was a shift of structure. But on average, you never want to like sell if you have a lot of bullishness, which is why in this trade, I noticed like, okay, there's really not a lot of bullishness here at all, which means sellers are in control. I'm watching price behavior very closely because as you see, there's not many indicators on my chart. The only indicator I have on is the EMA. Other than that, I'm relying heavily on price action to show me where the market's going to go, which is why I need to see the actual reactions of the market themselves. I want to see how the candles are forming. Super important for me. And when I saw the break and retest happening, I was watching it. I could tell that it was going to reject because of price behavior. These wicks right here kind of gives you that hint that the market's going to go bearish. It's not just the wicks because traders get confused. It's not just the wicks. It's the wicks combined with the large bearish candles. It shows me not only is there strong selling pressure, but also the market's rejecting the upside. It's rejecting the upside and there's strong selling pressure. That's when it's pretty obvious, and that's when it's just probabilities. Like, okay, probability states that we're probably going to melt down a lot. That's how I look at it. It's very, very, very simple. And honestly, this big move that happened down, that told me a lot about where the market was going to go. So how do I actually keep my psychology in check during trades like these? This one is very easy because at the end of the day, the market moved down in profit. So when I went to sleep, it was already in profit halfway. And I knew it's likely to keep going down, right? There's no point in closing out early out of a trade that is trending strongly and you have all of the higher time frames in your favor. If this was a counter trend trade, which is why I don't take those type of trades, then I would be super worried about going to sleep with this trade open. But because I'm trading with the higher time frame in my favor, it doesn't matter. Like, it literally doesn't matter. You can literally close your eyes. The market's just going to go in that same direction. That's why my strategy is called ride the wave. You just want to ride the wave of the market. You never want to go against it, because if you go against it, yes, you can make money, but you have to be so precise all of the time. When you're trading with the trend, you just let it go and it's likely to just continue in profit. And that's exactly what I did here. I went to sleep, I woke up to more profit, and then it continued and continued until it hit my take profit. And it's probably going to keep going down as well. This is why you want to ride the wave of the market. You want to look at market structure and you want to enter in on the lower high points if you're in a bearish structure. Always you want to enter in at the lower high points, because you could be bearish, but if you enter in at the bottom, you get stopped out and then it goes in your favor. And I bet that's happened to a lot of you guys out there. Timing is important. You want to know where you are in the structure So are you at a lower high? Are you at a lower low? If you're at a lower low and you like the trend a lot, you know it's going to keep going, you have to wait for the pullback. Be patient and wait for the pullback, because once you enter in on the pullback, you're going to be able to catch this entire move down. And you have so much flexibility. And even if the market structure shifts, even if the trend reverses, you'll still have profit. Let's see if I can draw it here again. Let's take a look at this. So let's put this in black. Let's say you have a bearish market structure and then you get unlucky. Let's say you enter it right here, right before it shifts. Let's say you entered in at the worst possible point, literally right before the market is going to go bullish after being bearish. Even if you enter in at the slower high, you'll still have some profit before the market continues bullish. Because when you enter in at a point like that, you get so much freedom. You get flexibility because it's always going to pull back. The market moves in a certain way. The market's not going to like go like this and then just go straight up. It never does this. It always does this instead. And because the market moves in waves, which is why my strategy once again is called ride the wave, if you enter at a lower high on a bearish trend, it's hard to lose. Like, it's literally just hard to lose, because even if it shifts in structure, you can just identify the fact that we made a higher low and I'm like, oh shit, like let me exit out of this trade quickly because this low is higher than this one. And if I'm in a bearish trend and if I'm in a sell position, then I don't want it to keep going. I don't want it to keep making higher highs. So I'm simply going to exit out of my trade right here around break even, and you don't take a loss. It's hard to lose when you enter in at the right time. But if you enter on the wrong time, even on the right trend, you can get stopped out and lose the trade. So super, super, super important to understand structure for this exact reason. That's why it was a little bit risky to enter in here, because it could have pulled back. But all in all, it was still a good point to enter in, because the market did pull back and it did reject off of this area of resistance. So very, very clear. Look at this. This is a perfect example of market structure right here. You have a bearish structure going down. And if we want to mark it up, we can look at lower lows, lower highs, consistently. Once again, I didn't even plan this out, but look at this example right here. Let's say you enter in short right here. You still have profit. The market still goes in profit before then reversing. So that profit, you can just simply close out at break even once you see that the market has officially made a higher low relative to the previous low, right? So even if you enter at the bottom, at the end of a trend, you can still close out at break even. You still don't get screwed over. So it's all about timing and it's all about understanding structure. This is another great example right here. If the market's going down consistently, all you simply want to do is enter in at a lower high. You place your short position. You place your stop loss above previous highs, previous areas of resistance. Ideally, it would be on the 4-hour time frame. I'm just not going to switch right now because it would mess up the chart. But ideally, it would be above a 4-hour area of resistance. Boom, you get your entry. You place your take profit. If your take profit doesn't get hit and the market reverses after being in profit so much, maybe you close out at break even, or maybe you close out with a trailing stop loss. But at that point, you have flexibility and that's a good position to be in. So once again, look at this market structure. This is the fundamental basis of my entire strategy. And if you practice this and if you master this, I'm telling you, you're never going to struggle to find winning trades again. You're literally going to always be in profits if you master the strategy, because it's how the market actually moves. It doesn't move anything related to SMC or ICT. It moves like this. And you can see it here once again. You have kind of a bearish structure turns into a consolidation. And then we started making higher highs, higher lows, and now the continuation to the upside. And it's exactly how I caught my sell on USD CHF, and it's exactly how I've been taking these trades. Euro AUD, I had a insane trade last week on Euro AUD. I closed out here, made really good profit, well over 10K. I could have potentially made triple that if I would have held, because I was just so correct on this analysis, all based on market structure. If you look at these circles, lower high, lower low, lower high, boom, retest of resistance. It can't be any more perfect than this. Retest at resistance at 178,500. Beautiful, beautiful trade. caught this entire thing. This is what I'm telling you. I'm on a winning streak right now. I've been on winning streaks and I've been winning a lot more than I've been losing. So this shit works. Go apply it and let me know what happens when you guys apply this in the strategy below. Or sorry, when you apply the strategy in the comments below. So I'll see you in the next video, and I hope this can help one of you guys out to trade better and to actually start making profits, because it's really not that hard. And I don't want anyone out there to be overcomplicating trading for no reason.